Hi, Aussie viewers. Homeowners across Australia are experiencing shock, anger, and heartbreak as another major building company collapses, leaving hundreds of families stuck with unfinished homes and no clear answers. Construction has now been halted on more than 700 residential projects, and work is expected to remain paused for at least the next 5 weeks, while administrators urgently review the company's financial position. Many affected customers are calling on the Andrews government to step in, urging regulators to take stronger action to protect everyday Australians who are being caught in these failures through no fault of their own. If you're planning to build a home in Australia in 2026, there is a very real risk that your builder may not survive long enough to complete the project, and if that happens, your deposit could disappear along with them. Construction costs are forecast to keep rising, with increases of around 4 to 6% expected across most major cities. By the end of this video, you'll understand the critical protection measures you must have in place before signing any building contract in 2026, along with the warning signs that could indicate your builder is heading towards serious financial trouble. At first glance, the construction market appears strong. According to the latest construction market update from industry analyst Levitt Bucknell, Australia entered 2026 with construction activity close to record levels, delivering approximately $298 billion worth of work during 2024 and 2025. On the surface, those figures sound encouraging, but the reality beneath them is far more concerning. Despite this high level of activity, construction costs are still forecast to rise significantly in 2026. Sydney is expected to see increases of around 4%, Perth approximately 5.3%, Brisbane and the Gold Coast between 5 and 5.5%, and Townsville around 6%, the highest nationally. More concerning is that the current period of relative price stability is expected to be short-lived. Industry forecasts suggest demand will tighten again from late 2026 as approved projects move into active construction. Pressure is expected to intensify further from 2027 as labour and resources are redirected north to support Brisbane's 2032 Olympic infrastructure program. In simple terms, anyone building in 2026 is entering a narrow window that may close quickly as conditions worsen. Rising costs are only one part of the problem. There are several additional risks that could completely derail a residential build, and assuming that only a few poorly managed builders are being weeded out is one of the most dangerous mistakes homeowners can make. What Australia is experiencing is not a routine industry correction, but a deeper structural failure. The data is confronting. ASIC figures show that 2,546 construction firms collapsed in 2023, representing a 42% increase on the previous year. In 2024, failures rose again to 3,217, a further 26% increase. By the first 3 quarters of 2025, insolvencies were already tracking 24% higher than the same period the year before. In just 2 years, between May 2023 and May 2025, more than 5,000 construction companies collapsed nationwide. Construction now accounts for approximately 27% of all corporate failures in Australia, an unprecedented share for a single industry. Most homeowners make one critical assumption when their builder collapses, and that assumption often turns a bad situation into a financial disaster. The reality usually unfolds like this. You save for years, sign a contract, and pay a substantial deposit, sometimes $50,000, $100,000, or more. Construction begins, the slab is poured, the frame goes up, and you can finally see your future home taking shape. Then, without warning, the call comes. Your builder has entered voluntary administration. When you contact the liquidator, you discover that you are an unsecured creditor, positioned at the very bottom of the repayment list. Your deposit has already been absorbed into the builder's operating account and used to fund other projects or service debts. When you attempt to engage a new builder to finish the job, quotes often come back 30 to 40% higher than your original contract, as costs have risen significantly since you first signed. Home building compensation insurance does not respond immediately, with waiting periods of up to 5 weeks in some states. Even when it does respond, coverage limits are often far lower than the cost to complete the home. In Victoria, payouts are capped at 20% of the contract value. Restructuring experts have repeatedly pointed out that everyday homeowners have very limited protection because builder deposits are not held in trust accounts. Once paid, that money is effectively unsecured. If you are planning to build, there are 5 protection steps that are absolutely essential. First, never make any payment until home building compensation insurance is confirmed and you have received the certificate. Builders are legally required to have this insurance in place for projects over $20,000, and they cannot lawfully request payment without it. During past major collapses, many homeowners discovered insurance had not even been taken out, leaving families completely exposed. You must also understand policy limits, which vary widely by state and are often far lower than the total build cost. Second, never pay more than a 10% deposit before construction begins. In most states, this is the legal maximum. Requests for higher deposits are a major warning sign and often indicate cash flow stress. Third, only make progress payments that are clearly authorised under your contract and tied to completed stages of work. Never pay early, even if the builder asks for assistance. Regulators warn that unauthorised early payments may not be recoverable under compensation schemes if the builder collapses. Fourth, conduct thorough financial due diligence before signing anything. Check the builder's licence status, search ASIC records for insolvency history or court judgments, and speak directly to clients whose projects were completed within the past 12 months. Payment schedules should also be reviewed carefully, as front-loaded or poorly aligned milestones can indicate financial instability. Fifth, once construction begins, maintain respectful communication with subcontractors on your site. Late payments to trades are one of the earliest warning signs of financial distress. Insolvency practitioners report that delays of 60 to 90 days often precede collapse, and if multiple subcontractors have not been paid for weeks, the risk is serious. Construction costs in 2026 are being driven higher by three major forces. Labour shortages continue to worsen, with ABS data showing completion times have increased by around 40% compared to pre-pandemic levels. The industry simply does not have enough qualified workers. By mid-2027, construction will require around 300,000 additional workers, and as demand exceeds supply, wages rise sharply. Economists warn that elevated wage growth is likely to continue through 2027 and 2028. Material costs also remain highly volatile. Electricity prices jumped 9% in the third quarter of 2025 alone and nearly 24% year on year, directly increasing the cost of cement, bricks, aluminium, and copper. Timber supplies remain constrained following the end of native forest logging in several states, while brick manufacturing costs continue to rise due to gas-dependent kilns. Major banks and investment firms have revised copper price forecasts upward by more than 8%. The Brisbane 2032 Olympics are already reshaping national construction markets. Labour and resources are being drawn into Queensland, pushing Brisbane building costs toward projected annual increases of up to 10% by 2028. Sydney and Melbourne are also affected as workforce availability tightens across the country, and regional areas near Olympic projects face even greater volatility. Industry data suggests there may be a short window of opportunity, roughly 6 to 12 months in early 2026, where well-prepared projects can proceed before conditions tighten further. However, that window only exists for those who follow every protection step. Cutting corners on due diligence or accepting inadequate insurance significantly increases risk. While some forecasts suggest moderate demand through 2026, insolvency levels are expected to remain elevated and caution remains essential. If your project is ready, your builder passes all checks, and you have strong financial buffers, early 2026 may be workable. If not, waiting may be the safer choice. Researchers from UNSW have highlighted a sobering reality. Building or renovating a home is one of the largest financial commitments most Australians will ever make, yet it has far fewer consumer protections than other major investments. Money paid to lawyers is held in trust. Bank deposits are government guaranteed. Builder deposits, however, go straight into operating accounts and can be spent immediately. Construction costs are rising, builder failures are accelerating, labour shortages are worsening. But if you follow the protection strategies outlined in this video, you can significantly reduce your risk. This is Aussie Property Hub, and we closely track Australia's construction market, builder insolvencies, cost movements, and consumer protection strategies that matter. Because once your contract is signed, it is often too late. The question isn't whether building in 2026 is possible. The real question is whether you are prepared to protect yourself. Thanks for watching. Don't forget to subscribe and press the bell icon for more videos.